Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go. Welcome, everyone, to another edition of the SHP Retirement Roadmap podcast. I'm here, as always, with Derek Gregoire, Keith Ellis, and today we are joined by Peter Roache, a CPA for Donellon, Orcutt, Patch, and Stallard. He has been a partner since 2004, and they've specialized in preparing tax returns, financial statements, and managing consulting for companies with annual revenues of $100,000 up to $100 million. They typically work with business owners and their families, but they're always open to referrals from guys like us, I guess, altogether. But all in all, Peter has been fantastic when it comes to doing the tax planning, which is a pillar of what we do when we develop the retirement roadmap for our clients, knowing that tax planning is something that you can be very proactive about, that you don't have to speculate on, that can really make sure that you are doing, leaving no stone unturned for every single one of our SHP clients. So, Peter, thank you so much for joining us and for all that you've done for SHP. Thanks for having me.
Hey, Peter, I have a quick question right off the bat here, is that in the financial world, this isn't patting us on the back, but do a lot of people that come to you as that have financial planners, financial advisors, are they doing extensive tax planning, or are they more just managing clients' portfolios and saying, talk to your CPA about taxes? Or are most people proactive in doing active tax planning within a retirement plan?
No, I would say the latter. They're not very proactive, whether it be about a retirement plan or any other investments that the people have. For the most part, I would say that it's more after the fact.
Like reactionary?
Reactionary as opposed to, in dealing with you guys, it's more proactive. Well,
I think back when we started in 2003, I think everyone should know that it wasn't normal to do anything but manage clients' portfolio. However, if you look back to talking to clients over the years, this back in 2003, 4, or 5, we weren't having these conversations either about taxes because we didn't know much about it. And then all of a sudden, over the years, clients would keep saying, people would come to us with all these concerns. And it wasn't always around investments. It was about taxes and what's going to happen in taxes. And then you've seen all these tax changes. We saw a few years ago, taxes got pulled back. The rates got pulled back a little bit from their previous highs. And we know in the future, in 2026, I think it is, they're going at least back up to where they were. But there's so much legislation that most people think it's going to be higher. So now, the concern we hear all the time is around, we're concerned about the markets, we're concerned about having enough income, but a lot of that's going to be predicated on what happes with taxes. Well,
yeah, and even without sort of, I know Peter about to hop into it, but have you seen the tax code just get more and more complex? And is your work gotten harder and harder as they continue to pass more and more laws, which is like 1,000 pages per and whatnot?
Yeah, any time that you hear government say paperwork reduction, it usually means 3 times more. This past year was the worst, where we got into March and they're still passing tax law for 2020.
Oh, get out!
So the IRS software was rewritten around 3 times last year.
And I can't imagine they have the best coders at the IRS either. I mean, I don't know. You tell me.
No, from what I hear, their IT is supposed to be 4 or 5 generations behind what most businesses.
That makes sense. So basically, a lot of times, like throughout this year, at least as in each year is a different year, for the last 2 or 3 years, one of the biggest tax planning opportunities that we've seen is around Roth conversions. And we're going to get into some other neat strategies later on, but from a Roth conversion standpoint, what's your overall thoughts? I guess we can, Keith, maybe take us through the process, and then maybe Peter can comment on just overall thoughts on, if it's appropriate and when it's appropriate for certain individuals.
Yeah, I mean, the idea of a Roth conversion is taking a look at your income, making, again, like Derek said, to make sure it's right for you as an individual. But what you're doing is you're voluntarily taking money out of your IRA, or, quote unquote, a distribution from your IRA, paying taxes at what we call a controlled tax rate, because you're doing it in a way that you know what you're going to be paying ahead of time, and then putting it into a Roth IRA. And, we believe that is an important strategy for people to be looking at and try to or consider and unlock in their retirement future. So I don't know if you have anything else to add to that, the importance of that, or, some thoughts around that.
Yeah, I guess one of the things that we try and do with the Roth conversions is look at what the tax rates are today. We know what they are today. We don't know what they're going to be tomorrow.
Correct.
Exactly.
And tomorrow could be a change for all of 21. It could be a change for January 1st, 2022. But go with what we know. And I mean, we're fairly certain that rates are not going to go down. So, we look at a rate where someone's comfortable at paying, and it makes sense to move some money tax-free over.
Yeah, I mean, and it's funny because we have this conversation all the time with the families we work with, and a lot of folks will come in and they'll be concerned specifically about one risk, and that's market risk. And then we kind of educate them through our process about what we believe is another, a real big risk, which is tax risk. Like you said, we'll be in a room with people and we'll ask, how many people think tax rates are going to stay the same or go up in the future, and rather go up in the future. And I think every hand goes up in the room because they believe that obviously, like you just said, tax rates are probably going to go up. And the question is, well, how many of you are proactively planning against that? And not many people, and you kind of get some crazy looks and like, hey, they don't know what we're talking about. And then we get into it. And one of the strategies we just talked about is that Roth IRA conversion. And like you said, if you believe taxes are going up in the future and we do the analysis and we think it's the right move, we're going to walk you through that process and how it works.
Yeah, think about once you go through that Roth conversion process, you're rinsing the taxes on that money. And a lot of people think, well, if I do that, I have less money in that account in the Roth IRA. But you have to realize whatever percentage the government owns today, right? Let's say you have $1 million IRA, and let's say you own 700 and they own 300, hypothetically. Well, their 300 portion still grows while the rest of your 700 grows just as well. But they might want more of it down the road. So we always say, if we can, Keith made a great point, the tax risk is so important because that's something, I forget the quote, but like the investments in the markets are it's our best guess. We do planning, we allocate, we plan smart, we invest accordingly, but we don't know what's going to happen day to day. The tax codes are literally, we know where they are. So when we have knowledge exactly what we're dealing with, we can make educated decisions, because if we can have someone pay 12% today as opposed to 25% down the road, it makes sense. And we've probably done, I'm guessing, over 100 conversions in 2021 alone. And Peter and our team work with so many mutual clients. So a lot of times, if we take you through the tax code, I believe it's around, based on your income, I think it's the first 20,000 or so is 10%. Then from 20 to 80, it goes to 12, right? Then from 80 to 170, it goes to 22.
Yeah. So do you have all these memorized?
I do not.
How do I?
I was curious if CPAs had them memorized or not.
So the non-CPA over here is giving the CPA.
He's giving me the tax brackets.
But a lot of times, if let's say a client is going to be if they're going to be over 120,000 in retirement with Social Security, dividends, rental, pension, minimum distributions, if you're going to be in that lane anyways, which today is 22%, most likely that 22% is going to be higher. We can't say for sure.
Right.
So if we can pay 22% now where we know where the taxes are and just be done with it, move it to that tax-free bucket, number one, you're paying less taxes on that money in that scenario. Number two, though, in the future, you have more flexibility because now you have some pre-tax accounts, some tax-free accounts. So you can almost, in the future, say, okay, I'm going to get to this level of income in 10 years from now with my IRA, Social Security, but the additional amount, I'm not going to go into the next tax bracket because the rest of my income is going to come from Roth.
Right.
Does that make sense?
Right. So you're in essence taking that $1 million, and if you rolled over 20% of it, you're locking that tax cost in at the 60,000.
Yep.
And the rest of it's growing. Is that's it? You've paid your bill to the IRS, and
Right.
the rest of it's going to grow for the rest of the time that you have it in there, tax free. So you've got that growth, and then it gives you that planning opportunity down the road when you are drawing on the accounts to adjust your taxable income in different years based on different things that are happening in your life. Maybe you sold some real estate in a year and you had a big capital gain, so I don't need the money out of my Roth, or I can keep my minimum distributions down as low as possible. Or some years I'm not going to have as much income, I need some of that tax-free money.
Yeah, so it's basically creating tax diversification, right?
Right.
And that's really the idea. And also, I think it's important too, if you're a married couple, the idea of creating the Roth IRA for the future, because at some point, unless you both pass away at the exact same time, there's going to be a time where they go from a joint filer to a single filer, and then the tax rates become, or the taxes can become a little bit more aggressive as a single filer. So that's where that tax-free money could be more important too.
Right. So then as a single person, then having that flexibility is probably even more important because, like you said, Keith, the rates jump as a single person versus the married.
And I guess, what do you guys think? Like, where do you think it all started? Remember how there was the myth that, okay, hey, no, pay, defer your taxes now because your income's going to be lower in the future, and so the whole IRA and 401k business, the whole thing was predicated on, take your write-off now because in the future your income's going to be lower and tax bracket's going to be lower, and it just doesn't seem to be the case. And so I'm not sure if it was true way back then.
Was it a setup, Peter? Was it an IRS setup?
I would have to
like the
say
way.
it's probably, that conversation probably started right around the time when your defined benefit plans moved over to pretty much everybody went to the defined contribution plans.
Mm-hmm.
That's basically the pensions went away.
Yeah, for all of our listeners. Yeah, exactly. What Derek just said. Yeah, for all of our listeners, because he's saying DBCs, defined benefit, but that's, pensions to 401ks is what
traditional pensions went away, and it was all on the employee.
Yep.
How do we get people to contribute to these plans because this is going to be their retirement savings? Well, we'll give them a tax break.
Yeah, exactly. And then basically, but most of the clients that we see, there's some that can stay in a pretty reasonable tax bracket in retirement. But a lot of times, if they've saved up a lot of money pre-tax, that minimum distribution that they have to take out at 72, combined with Social Security and other income, usually pushes them up to that level, which is going to be hard to plan around. You're going to be in a high tax bracket.
Well, and that's the thing too, Derek. And I'm not sure if you've seen it, and I wish I had more scientific numbers. But I feel like there's about maybe 20% or 2 out of 10 where we do the Roth conversion calculations, and it doesn't make a sense.
Yeah.
But it's all at least 80%. I mean, again, non-scientific, small sample size. But I'd say a heavy majority of the people that we crunch numbers for does work out better, where very few end up staying in a smaller bracket without taking proactive steps.
I actually think it's an interesting time right now because if you think about it, when a lot of the families we work with were working, tax rates were higher, so they got the benefit of the contribution. Mm-hmm. Now tax rates have come down and they get the benefit of the conversion. They're almost winning on both ends.
That's a good point. Yeah, absolutely. Historically speaking.
And Peter, also, when you're retired, right, and you're 65 or older, now your income is also changing based on Medicare premiums,
right.
Social Security tax. So there's additional taxes that come into play the more that your income that you have.
The only catch to that, the Medicare premiums, they do take into account Roth distributions as well for your modified adjusted gross income.
Got it. So you have to fact. But if you do a conversion, not to get, this is going to be a technical. Sorry, I'm already sorry about this. If you do a conversion in your 60s, right, and you don't need to take money, you have less money to take out of a 401k or IRA because you converted it to Roth before you're 72. So let's say instead of having $1 million in IRA at 72, now you have $500,000 in IRA because the rest is all Roth, and you don't need the distributions. Then your tax bracket's going to be lower because there's less to draw from in the.
Right. So it's a double benefit there that you've lowered your required minimum distributions, and you've got this money that's there for you if you need it.
Exactly. So, but you can play around with it. You can play around. It's not with a Roth IRA. You're not forced to take minimum distributions at age 72.
Ever.
So with an IRA 401k at that point, you're forced basically with a few situations if you're working and you're on a 401k plan, but mostly you're going to have to take a distribution at age 72.
Right.
Have you?
Oh, good.
Have you? Some of the families that you work with, a lot of the goals, at least we work with as well. Their goal is legacy, right? And then the Secure Act passed at the end of 2019. Yep. Have you had a lot of people ask you about that, the impact planning strategies, or is that kind of something that you think was more or less, I don't want to say swept under the rug because then COVID followed and this Secure Act kind of everyone forgot about, but there is a massive impact to retirees, and it's a huge, in my opinion, maybe I'm wrong, you can correct me, I think it's a massive tax grab by the government.
I agree in both cases that it was a little bit swept under the rug, and COVID helped push it under there. It wasn't really on people's radar, but yeah, it definitely does change.
Well, it's a great Christmas present because it passed right around there, right?
Definitely changes some of the legacy planning, like you said, Keith.
Well, if you have everyone's like, oh, like I had a client in last week. They thought, oh, I'm 70, I have to take a minimum distribution out, and I said, no, you don't actually. It's now 72, and they had no idea. I said, wow, this actually worked in our favor, and I said, well, when you pass away, this is the trade-off is. Your heirs, let's say you had $1 million IRA, they could take it over their entire lifetime. So they could take little distributions each year, not a big tax impact, and so forth. Well, they gave you 2 extra years before you have to withdraw it, which means it can grow more, which means more taxes. But then when you pass away, now as part of the Secure Act, your heirs have to take all that pre-tax money out over 10 years. And if you look at the baby boomers, when a lot of them pass away based on life expectancy, their kids are probably going to be in that 55 to 60 high income earning years where they have to take now another $1 million out over 10 years of taxable income.
Right. And then just to add to that, just to clarify too, Peter, from my understanding, the funkiest part about the Secure Act, as Derek was mentioning, but the whole 10-year thing, is that you can actually delay it for 10 years and then take it all out in one year if you really wanted to.
If you really wanted to.
Well, here's where
the Roth that would work.
100% for the Roth, that's where it makes sense.
Because if you pass away with a Roth, again, your heirs usually could stretch that out over their lifetime. Now they have to take it out over 10 years, where the Roth's tax-free. You might want to not touch it for 10 years. Then on 9 years, 364 days, cash that baby in and get the tax-free distribution at the highest amount.
Yeah, it is really a double whammy because, like you said, if you're passing away in your 80s, your kids are probably in their 50s, so they're in their highest tax bracket that they're probably going to be in. And now you've got this extra money that you have to take out.
Yep.
In a weird way, it would almost force retirement within 10 years because if you knew that, then the IRA, maybe you retire 8 years into that.
And have
last
that part
2
of your income.
years, you take that as your income. There's a lot of planning that can go into that.
And that's what I was going to say, Peter. Like, how often, have you seen people? Because Derek was just saying, was it last week or whenever that client was coming in that they didn't even realize, or they still forget about the 70.5, much less the 10-year thing. Have you seen people come into your the office and just be like, wait, what? I have to take out this money? I mean, have you seen that start to come across your board?
I think more. In line with Derek's client, in that people don't really realize yet that they've got the extra 2 years.
Yeah.
Mm-hmm. They're still, I turned 70.5 this year. I've got to take money out.
Yeah. Well, that's the thing. I think the main thing we always try to convey is like the ripple effect of this type of planning between here at SHP. It's more, and this show isn't about us. It's trying to help you, the listener, but it's really looking at your entire picture. And you can tell from the last few podcasts, right? We've had Attorney McManus on talking about estate planning. We've had Scott Hoganson talking about health insurance and Medicare planning, and now we have Peter talking about tax planning. So the days of just having a portfolio and like, oh, I can retire, I have a portfolio. This should wake you up just to show you how many things you have to think about when you're building a true retirement plan. Beyond just, hey, I can use Vanguard or Fidelity or Schwab and just put some money in an ETF and call it a day. Well, maybe you can, but make sure you're still getting help in all these other areas besides just the investment piece.
Yeah, or at least make sure your heirs are following up on all of that because they're going to have to deal with the issues.
Exactly.
Well, then also, Peter, to the point, current legislation, we know proposed legislation is different from enacted legislation, but, can you give our listeners any updates on what they're talking about, specific highlights that people should be talking about?
Or lowlights.
I was going to say highlights.
Yeah, great point. Great point.
Well, I mean, I guess just in a word, what they're looking at is everything. They're looking at taxing, a wealth tax, an annual wealth tax. They're looking at increasing the tax rates themselves back to.
What's the annual wealth tax?
So if your overall net worth is over
$5 million, right? Is that what it is?
I've seen $1 million. I've seen
Okay.
$5 million.
Is this net worth or investable assets?
Net worth. So everything that you own, no discounts if it's a family limited partnership or anything.
Wow.
Wow.
So how would you get what if you own a business? How would you'd have to get that appraised
Every year?
Technically.
technically? And then so basically there's going to be just because
Apparently, this is your and Derek's consultation.
no, so easy. So if you had a certain net worth,
2%.
2%. Okay.
That's it, yeah.
So if you have $5 million or $10 million, there'd be an extra $200,000 taxed.
Write the check.
Just because you have that money.
Right, because you've accumulated that much.
They don't want
of
you
a
to use
net
that
worth.
money to hire an employee or something like that.
Right.
That could be a nice incentive. Why don't they do that?
Hey, you
know what I
worked
mean?
hard and saved money, so pay.
It's almost like how they did the PPP
Right.
loan. If you hire someone and kept them, that would be a nice. I don't know. Maybe I could make that suggestion to the IRS.
And that's all
you
pretty
call
much
up,
after.
Senator Warren. She'll take your call. Keith.
Well, it's
Yes.
after
She's
tax
waiting for
dollars.
it.
Right,
Yes.
the majority. I mean, granted, a chunk of your net worth is going to be your IRA and pre-tax money, but I would assume the majority of it's still going to be after.
Wow.
And sorry, that was and you just said one, and I already lost. I've lost it a little bit.
Yeah.
So
What are some
was
other
it?
low
Yeah,
lights?
Stop.
Yeah.
Wait, let's break
This is-
that
yeah.
one down.
Yeah.
Income tax rates going back up to the pre 2017 changes.
Okay.
Yep.
So
Is that across the board? Because I thought I saw like only 400K and above or the higher bracket, or we've also seen anything like.
so? The old rates, $600,000 of income got you in the top rate.
Mhm.
At 400,000 now, you'd be at the 39.6%.
Got it. Okay.
Oh. Okay.
All right. So it's the raising it and then lower. So expanding the
Expand the
net.
base.
Yeah. Expand the base. Right. Expanding the net. And
Yeah, it's $200,000
raising it up.
net.
Continue
Right.
with this amazing news.
Capital gains.
It's like I think we lost all these listeners.
Yeah, I'm done. I'm done planning.
Capital gains
Depression.
rates to
Yeah,
between
right.
25 and 28%.
I heard that exactly. Yeah. So now, like, if you have a stock that's appreciated, you sell it. Instead of the 15, you're getting another 10% on that.
Right now it's 50, 0, 15, or 20.
Right, 0, 15. There's a 10% in there too, but the majority of people are paying 15 or 20%.
Sure.
Yep.
So now it would go up to somewhere between 25 and 28.
Wow.
How about capital gains on the next generation?
Yeah. Step up in basis.
So
Thank you.
step up, they're talking about
Getting rid of,
reducing
right?
the exemption. So right now you could pass away with $11 million worth of assets and not pay any federal tax, estate tax. They want to reduce that. I haven't seen the number on where they want to reduce it to, but also then do away with the step up in basis. So if you've got an estate worth $5 million and we'll say they reduce it back to the $1 million it used to be, you're going to pay a tax on the $4 million difference. At the current rates, 40%, so $1.6 million. And your heirs' basis in it is still whatever your basis was, so they no longer get that step up.
So
You know
the
what's-
easiest planning solution is to move? I'm just
Yeah.
kidding.
No, federal. That's federal. You have to do another country.
No, that's what I
Right.
mean.
So, no, what's crazy, and I know I'm on the. Keith's gonna hate me for saying this, but I'm I'm against raising taxes and all that stuff. But to me, the step up in basis, to me, that's like a fair thing if they wanted to. Because if you put $1 million in Apple stock 20 years ago and it's worth 20 million or whatever, and you pass away, your kids inherit that at no tax. To me, that's a fair thing to tax. If they're going to tax something, at least all right, you put an X, it grew to Y, a capital gain tax on that, even at death, is it's a fair thing. Then other than just saying, all right, you have this much money, we're going to tax you 2% because your net worth's over $5 million. That's just like arbitrary. This is like to me, that would be like and I don't want it to happen, but I could reason with it. Maybe, am I crazy?
I would say, 15 years ago, it would be crazy to say, we're not going to do step up in basis. Now, at least with the reporting requirements where everybody, Fidelity, Schwab, everybody's got to keep the basis. At least the documents, the records would be there so we would know
Yeah.
versus
From years ago.
right trying to
That'd be
figure
a
out what
mess.
somebody
That's
paid
true.
in 1995 for
I
that
see.
Apple stock.
Yeah, that's true.
Yeah, and that's definitely one thing. Talk about a topic for another show is that whole idea of the reporting requirements, and we see that. I see that a lot, where clients would come in with this old AT&T stock that their grandmother gave them, and it's like, oh my gosh, we have to do like this forensic accounting to figure out when the dividends and the splits and all
there's
that
like
stuff.
20 hours of work going into that. As soon as they say,
Yes.
I have this old
There's
stock,
30
I'm not sure the
shares.
cost basis. I say, well, Peter's going to have about 20 hours. My team's going to have about 20 hours. So
Yeah.
I guess we'll get working
Right.
on this.
So, but I see your point though, Derek. I mean, like it's funny. It's like whether it's like the step-up basis or the estate tax. Like I don't think it should be $1 million or anything like that. But anything that doesn't get people from working hard, you know what I mean?
Correct.
It's like taxing income is one thing, but taxing the Rockefellers, I'm all right with certain ones up to a point.
Well, and I think
Or the Gregoires and the Rockefellers and the Kennedys.
yeah, it's
Sorry.
all in the same lane, definitely. Let's go to a brighter topic, which I think is a cool opportunity for people that have 401k plans and have the ability to fund it. And they call it like the mega backdoor Roth conversion, right?
Right.
And we had a client just this week. We were emailing back and forth, Peter, that's working on doing this exact same thing. So, explain if you can explain just a little background of what is the backdoor mega Roth conversion within a 401k plan.
Well, even back up. Do a backdoor Roth conversion. Explain that, and then explain a mega backdoor Roth for all of our clients, or all our listeners. Sorry.
So the regular backdoor Roth is just a matter of you've exceeded or you don't qualify to put money into a Roth the traditional way of just writing the check and moving it in. The backdoor, you need to move the money into an IRA first, the traditional IRA, not have other IRA assets.
Yep.
Roll that money then immediately over to the Roth.
It's a non-deductible.
Non-deductible, so
IRA.
you're moving non-deductible money over to the Roth. So there's no tax consequence. It's just a two-step process.
And clarify why you can't have another Roth.
An
'Cause then-
IRA.
Yeah, another IRA. I'm sorry.
If you have another IRA, then the percentage to move that $6,000 or $7,000 over, it would be $6,000 as a percentage of your total IRA. So if you had $100,000 or $94,000 of IRA, now you put another $6 in. We move the $6 over. Only 6% of it is going to be tax-free.
$360 basically, or whatever that number.
Yeah, the majority of it would end up being a taxable distribution.
Yeah.
Yeah,
Okay.
and I think just in one more clarification, which I think people like the whole idea of a non-deductible IRA. I think there's a lot of sort of confusion out there because people think like, oh, I earn too much, I can't put it into an IRA. It's like, yes, you can, you just can't deduct it. And then you go from a non-deductible, so it's an IRA, just a normal IRA. You're just not deducting it from your taxes, and then you do the flip, assuming that we don't have the
Other
other
IRA
assets.
assets, yeah.
And so
All
the
right,
big,
your
that's the
backdoor.
small one.
That's just your normal
the
like
mega.
everyday- yeah, that's like your not your Mega Man. That's like your
Your
you
base.
you're just your standard not strong one.
We're more of a side door.
Yeah, a weak Roth.
The next one's like a back French door. Roth
Like a
conversion.
slider. Yeah. So with a 401k plan, you have as long as the 401k plan itself has the option of you can put after-tax money into a plan. So for people under 50, you get the $19,500 that you can put into a 401k. Then the company is typically going to match a portion of it. Say it's $10,000, $10,500 to make it easy. So you've got a total contribution into your plan of $30,000. The IRS allows you to put this year up to $58,000 total into a plan. So
It's 64 if you're over.
64 if
50,
you're
right?
over. Yeah. So you could put another $28,000 into the after-tax bucket of a 401k. From there, you can take that money and roll it into a Roth.
So think about if you put that after-tax money in anything else, you're going to pay all the future growth on capital gains, dividends, interest, and all that.
Well, especially as we were just talking about, if they do change the capital gains rate, that's even more powerful, that strategy.
it's amazing. Then if you do this, so my client, and I think it depends on doesn't it depend on how if your 401k is more top heavy?
Yeah, it does. There are a lot of
The ownership, you might not be able to.
Yeah, there's a lot to
there's
it.
a lot
There's
to
of
it,
fine
and
print,
depending on
versus
the plan
situation.
itself, right?
Yeah.
So typically, the larger the company you work for, the more options you're going to have.
Correct.
Versus a small company, but definitely, I would suggest anybody look into whether or not their plan allows for after-tax contributions because it can be a huge.
It's a
We
win.
were doing a review a few weeks ago of the client, and Peter and I were going back and forth on this, but just basically they are over 50, so they made their 24.5 for the year contribution. The company matched like 10.5, so they were about 35,000 of total contributions between the pre-tax or whatever that went in. Doesn't matter if it was Roth or pre-tax, but then the company match. They about let's say $34,000 to make it easy math that they had put in. And I said, why don't you call your employer, right, and just see if they have this after-tax option. Well, it turns out, so now he's put in 34 for the year. Most people think they're done. Well, if he has additional funds, he can contribute another 30,000 and change, which is 64 and change is the limit at that age.
Right.
And the plan has an automatic feature where every 6 months it takes any money in the pre-tax accounts and converts it to the Roth.
Oh, automatically?
In the after-tax.
I'm sorry. After yeah.
But it still happens
in the
automatic.
after-tax, yes.
But it happens so the client.
Because the longer if it goes on for too long, now you're going to pay on the interest. So the quicker you can make the contribution to the after-tax bucket and convert it, the quicker it goes into tax-free status.
Sure.
So think about that. He's in his 50s, $30,000 a year for 5 years. That's another 150 plus gains that the after-tax money goes to the Roth, where the guy, this client, awesome people, they make $700,000-800,000 a year combined. They would never be able to do a Roth contribution, and the conversion would be very expensive. So this is a good way to just get build up more tax-free money. Because a few years ago, when they signed on to work with us, they have a lot of assets and buildings and properties, and they make good money in boats and whatnot. And the goal was like, hey, as we get close to retirement, let's build more tax flexibility, tax diversification, so that everything you have isn't pre-tax, right? And that's this is another way to just chip away at that.
Oh, it's fantastic.
It is.
To say the least.
So you're getting $30,000 into a Roth IRA. So you're 4 to 5 years worth of Roth contributions in 1 year.
Yes,
so
right.
Derek said do that over 5 years.
It's a big number. It's a big number. So that's what we're saying. There's so many areas of tax planning, right? You're combining what we just talked about there with maybe some Roth contributions, with Roth conversions, right? And we haven't even talked about like tax loss harvesting.
Yeah, 1031 exchanges.
1031
and everything
exchanges
else.
in real estate.
So much.
So there's so many tax planning opportunities that, again, you might be out there and maybe these won't work for you, but you should really explore as many options as you can, because that's, we always say we don't want to leave any stone unturned. And that's why we work with all these professionals to make sure, hey, Peter's team is great at, again, a lot of times we kind of have an idea what we're doing, but I'll reach out to Peter. Hey, just to make sure we're doing this right, 64 and change is a limit. Like, you're always right back, and yep, that's what it is. You're on the same track. So I just don't want to miss anything. But just so important to kind of cover all these areas from a planning standpoint.
There's one way to make sure a plan won't work is to not ask the question.
Yeah. No, the best way to make it is just to do nothing.
Right.
If you do nothing,
right,
you know there's no chance. If you look under every rock and every stone and say, is there an option here? Is there an option here? There's so many things to check off that you can, and every time you do a little thing like that, it adds so much value to someone's plan, and you just want to keep stacking the deck in the client's favor. Mm-hmm. Things are out of our control, but as many things as we can control, it adds huge value over time.
And that's exactly why we want to thank you so much for coming out. There's going to be the landscape's going to constantly shift and change, and so I don't know.
Is there anything else, Peter, that we?
Yeah.
Is there anything else that from a planning standpoint or from a tax standpoint anything else that we missed that we should know about?
You touched on tax loss harvesting. That's something that the three of us always talk about.
You want to just do a quick rundown on that?
Sure. We're looking at when you've got taxable gains during the year, realized capital gains, offsetting any losses that you have, not buying the security back within the 30 days so that it's a wash sale, but to be able to offset the gains. And also in different times with different of your clients, when they've got a building sale or some other sale, where they've got a large capital gain, we're not so much worried about security gains. Then we're looking to offset that gain. So there's ways to offset other income other than just security gains and losses.
Exactly. Yep, that's another big one.
And that's great. And I was going to say, there's going to be so much, and as we were saying with our current legislation, the ground is shifting. So once we know more, we'd love to have you back. But just again, want to thank Peter Roache of Donellon, Orcutt, Patch, and Stallard. Thank you so much for you do for us personally, for the clients of SHP, and for all the listeners.
Thanks, Peter.
Thanks for having me.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.